Hello and welcome. In this lecture video, we're going to return to break-even analysis, talk about target profit analysis, and also talk about how to calculate and what is margin of safety. So you can see on page 186 of your course back, I'm listing two different ways to calculate break-even, the equation method, and then the contribution margin method. I'm going to cross out the equation method, and let's just focus on the contribution margin method, okay? So basically, this is the formula that I had reviewed in a prior lecture video. And the way to calculate break even in terms of sales units, how many units do we have to sell to break even, is we take our fixed expenses or fixed costs plus our profits divided by our CM per unit, contribution margin per unit, okay? Now, what are profits at break even? They're zero. So really, this just becomes fixed expenses plus zero, or just fixed expenses divided by contribution margin per unit. In terms of sales dollars, we can say it's our fixed expenses, again, zero profit at break even. But the reason that I have profits in here is because we can use this exact same formula for target profit analysis, which is the next topic that I'm going to talk about in this lecture video, okay? Divided by our CM ratio. Remember, our CM ratio says how much contribution margin do we get for every dollar of sales, okay? That's what this is telling us. So if we return back over here to our assumptions with our RBC bicycle, we can say, here's our fixed expenses. Our CM per unit is 200. So in terms of units, we simply just take our fixed costs divided plus our zero profits divided by our contribution margin per unit, 400 bikes, which is we did in a prior lecture video. In terms of sales dollars, how could we get that? Well, we can use this formula, but also because we only sell one bike, what we could do is just take the 400 bikes times the sales price per bike, which we know is $500. So the 400 times the 500 gives us 200,000. Or we could come over here and we could say our 80,000 divided by our CM ratio. Now remember our CM ratio, contribution margin ratio, we calculate that by dividing our CM by our sales. So 200 divided by 500, which is 0.4. Which gives us our $200,000 in terms of sales dollars. So our break even in terms of units is 400 units or 400 bikes. In terms of sales dollars, it's 200,000. Okay? So let's continue on. Page 187. Let's not worry about that. Let's go over here to page 188. Okay, so let's look at target profit. I'm going to get rid of this equation method over here. So we have the required units to reach the target profit using our formula that I just talked about. Our formula of fixed expenses, I'll write it out. Fixed expenses plus profits divided by CM per unit. In terms of sales dollars, it's fixed expenses or fixed costs plus profits divided by our CM ratio. Okay? Right there. So, let's look at our problem though. Assume RBC doesn't want to just break even, but they want to have a target net operating income of $100,000. How many bikes do they have to sell, and what are the sales dollars that they need to have to reach that target? Okay? So, I want you to pause the lecture video and figure this out. And then using this formula, determine how much they have to sell, or they, meaning RBC, has to sell in order to have a target profit of $100,000. The way you do that is use this formula for units, this formula for sales dollars. Pause the lecture video, and then we'll come back and talk about it. Okay, so let's see how you did. So you put your fixed costs plus your target profit divided by the CM per unit. You have to sell 900 bikes. Fixed costs plus the target profit divided by the contribution margin ratio, which we know is 0.4, $450,000. You could check your work because this is only one bike. You could multiply the number of bikes times the sales price per bike of 500 also gives you 450. Okay, so continuing on, page 189, we have this problem, which is a target profit problem. And I want you to pause the lecture video and solve this problem on your own, and then we'll come back and check it. Okay, so hopefully you got A. A is the right answer. So we take our fixed costs, which is given to us, plus our target profit, 2,500, divided by our contribution margin per unit. So you have to calculate that. You take the sales price minus the variable expenses. This would give you the contribution margin per unit. So fixed costs plus target profit divided by contribution margin per unit, 3,363 cups. This is the right answer. Okay. So now let's talk about the final topic in this lecture video, which is the margin of safety. So the concept of the margin of safety is the excess of sales, of actual sales, beyond or in excess of the break-even point. So for example, if break-even is 400 bikes and you are currently selling 450 bikes, break-even is 400 bikes, you're currently selling 450 bikes. The margin of safety is the number of units or sales dollars in excess of the break-even. So in that case, your break-even is 400, you're currently selling 450, break-even is 500, margin of safety is 50 bikes. The 450 that you're currently selling minus the 400 to break-even, that's how many bikes you're selling in excess of the margin of safety. Okay? So if we look at this problem, assuming RBC has sales of $250,000, what is the margin of safety in terms of sales dollars, and then as a percentage, and then we can also do it in terms of units, and then also as a percentage sold. So we can come over here and we know break-even sales dollars for RBC, we know that is equal to $200,000. Okay, and the way we got that, so we look back over here. Remember, this is 200, and this is 200. This is 120. This means 400 bikes would be our $200,000 in sales. That's our break-even point. That's something we've reviewed before. Okay, and then it says we're currently selling 250. What is our margin of safety? Okay, so break-even is 200, and then we say actual or current, this is what we're actually selling, is 250. That means our margin of safety is equal to our $50,000. That's our margin of safety in terms of sales dollars. As a percentage, well, we can take our 50,000 divided by our 250, so it's a percentage of the units that we're currently, it's a percentage, margin of safety is a percentage of our actual current sales dollars, gives us 0.2 or 20%. This is important to understand because this is what this is telling you is that if sales fall 20%, you stop making money. If sales fall 20% or by $50,000, you stop making money. You are at break even. You have no more profit. And if they fall by more than 20%, you're losing money. That's what the margin of safety is telling you. That's why it's so important. Okay. So we can do this in terms of units. Remember, break even in units for RBC is equal to 400 bikes. And if we're currently selling $250,000 in sales and each bike is sold for $500, that means we're selling 500 bikes right now. Actual sales, 500 bikes. That means our margin of safety is our 100 bikes. And then as a percentage, we can take our 100 divided by our 500, which is what we're actually selling, again gives us 0.2 or 20%. It's the same because we only sell one unit, but it's the same, and it's also the same interpretation. It's saying that, again, it's saying that if your sales drop by 20%, you stop making money. This is important to know, okay? Even if you don't want to be an accountant, even if you want to just run your own bike shop in downtown Fredericksburg, you need to know this, because once it hits 21%, you're losing money, okay? So I have this problem right over here, another coffee clutch problem. And so I want you to pause the lecture video and do this problem, and then we will review it together. I need to give you one hint to solve this problem, is that you first need to calculate break even, okay? So give it a try, unpause the lecture video, and then we'll go over it. Okay, so let's see how you did. So to calculate break even, we put our fixed cost divided by our contribution margin per unit. How did I get $1.13? I took $1.49 minus the 36 cents. That gives me 1,150 cups to break even. You can see that's one of the answers here. Okay, so that's put in here to see if you're thinking through this. And that is not the right answer. This is the break even, but that's not what I'm asking for. I'm asking for the margin of safety. Okay, so if you chose C, I gotcha. You got to read the questions carefully. It's not asking for break even, but margin of safety. So to calculate margin of safety, that's the amount of sales beyond the break even or in excess of the break even. So we're currently doing 2,100, right? 2,100 minus the break even, 950 cups. That's the MOS, margin of safety. That is the right answer. If you got that right, good for you. Okay. So in the next lecture video, I'm going to go ahead and end this lecture video. And the next one, we're going to be talking about how to calculate break even with multiple products. Okay. Thanks so much.